This is Declarations.
I love the tangibility of real estate. You get to touch and feel the product and effectuate real change that can impact human lives.
Hi, this is Todd Rich, and welcome to the Declarations podcast. The purpose of this podcast is to engage with thought leaders in investing who provide an independent perspective. Our goals are to explore the foundations behind their success, to understand the source of their inspiration, and through these conversations, to become better investors. We hope you enjoyed today's episode. I'm joined this afternoon by Ian Ross, founder and managing principal of SomeraRoad, an opportunistic real estate investment and development firm, which he launched in 2016 with a differentiated entrepreneurial approach to real estate investing. Under his leadership and alongside Ian's partner, Fergus Campbell, the firm has scaled rapidly, with more than $3.5 billion in total capitalization across more than 70 markets nationwide. Headquartered between New York and Nashville, with local offices in key markets across the country, the firm has expanded beyond its origins in deep opportunistic debt investing into industrial net leased properties, ground-up development, and aviation-related real estate with SR Aviation infrastructure. Declaration is proud to partner with Ian and SomeraRoad around credit-leased gas station properties. Prior to launching SomeraRoad, Ian was a managing director at Triangle Capital Group. Earlier in his career, he worked as an investment banker at Jefferies and on the CMBS desk at Morgan Stanley. Ian holds an MBA from the Wharton School at the University of Pennsylvania and a BBA from Emory University. I'm proud to partner with Ian and the broader SomeraRoad team. I'm confident you will enjoy this conversation about Ian's journey, his investment philosophy, and the growth of SomeraRoad. Ian, welcome.
Hey, Todd. Great to see you and great to be here. Appreciate you having me on.
Well, I'm really glad you're here. Ian, as you know, I like to start these podcasts in the same way.
Yep.
What is your declaration?
I love this tradition, Todd, and I gave this a lot of thought. My declaration is for my firm, SomeraRoad. SomeraRoad will never lose the entrepreneurial grit upon which we are built. We will work hard and we will work smart. We will be intentional, creative, and disciplined, serious students of our craft. We will know what we know, be honest about what we don't, and we will never be afraid of the new thing. We will surround ourselves with the best people who share in our values. We will be kind, honest partners, aggressive but disciplined, and be responsible stewards of capital. We will do what we say we're going to do. We will never get too comfortable. We will compete like underdogs even when we are not. Stay humble, and at the end of every day, we will look in the mirror knowing that we left it all on the field and gave it everything we had. I was a pretty bad high school football player growing up in LA. But I remember my high school football coach telling me, when you get off the field, you got to look in your mirror and know I gave it my all today. And that stayed with me. And I love that. I always say that to our team.
Well, there's so much in there that we can unpack, Ian. So thanks for sharing it. Let's maybe spend a second talking about where you started, which is entrepreneurial grit. What does that mean to you?
I think being able to challenge yourself to figure anything out, rolling up your sleeves, stepping into any role on a team and figuring out how to be at the best at whatever you're doing. We've always pushed ourselves and challenged us to grow and evolve. And I think the grit is what makes us really unique.
I think that's great. We're obviously going to talk a bit about how you started the firm and how you've been growing and evolving. But take us back to the very beginnings. Even before you were a mediocre high school football player, in your words, what was your childhood like? Tell me about the family.
I grew up in Los Angeles. I would say upper middle class. My parents always tell me the story about how they drove their $50 clunker across the country from Boston, where they both went to school, to LA, to the promised land of California. My dad was a physician and a researcher in the high-risk obstetrics field, a practicing OBGYN. My mom came from a business and consulting background and was the proud mother of 3 boys. She now spends a lot of time in nonprofits as an activist. I had a great upbringing. My parents instilled some phenomenal values, I think, within the 3 of us. I had a lot of exposure growing up, going to a top-notch prep school, to what the privileged lifestyle looked like, but it wasn't necessarily where I came from. And I think seeing that, but having the roots that my parents had fostered for us gave me a really unique position and outlook of the world. And I think that's affected me throughout my life.
It's so interesting how many of my podcast guests, the successful ones, have come from positions where they were exposed to real financial success, but didn't come from it themselves. I mean, do you feel like that's what gave you your entrepreneurial itch?
I saw what privilege looked like, and I was taught by my parents the hard work that was required to get there. And I wasn't just given things. I mean, it ended up on a birthday wish list, a Hanukkah list, a Christmas list. And I learned the art of hustling and being an entrepreneur in order to earn money to do the things and buy the things I wanted, whether it was, selling lemonade on the corner. I resold these Raven's Revenge sweet candies at camp. I would lug a cooler of sodas down on the Santa Monica bus to the beach and resell those that I had bought at Costco.
It really resonates. I personally I would bring a bag of blow pops into school in Hebrew school. And I remember distinctly, it was 25 cents a pop or 5 for $1.
At an early age, you realize the value of buying wholesale and selling retail. That expanded throughout my life to buying the limo for prom and syndicating it. I guess I was a promoter from an early age to promoting nightclubs. It runs the gamut.
And then for some reason, and maybe this is all related, when you went to Emory, right, you left LA, came to the East Coast, and you studied business with a major in real estate and finance, I think. So right from the get-go, you decided that real estate was something that you were interested in. What drew you to real estate?
I loved the tangibility of the asset class. I've had a lot of quant background, and I think in a lot of financial instruments, you don't get to touch and feel the product and effectuate real change that can impact human lives. And what I loved about real estate was that tangibility, was the real life impact that space has on people's lives.
You started off right after Emory. You went to Morgan Stanley, you were at Jefferies, so CMBS desk, investment banking. Do you feel the tangibility there?
Yeah, I mean, your underlying product is still a physical real estate asset. You can look, touch, feel, understand how a property is used. And the first experience I had on Wall Street in corporate finance was at Morgan Stanley, working on Steven Sturm and Jim Flom's CMBS large loan origination securitization desk in '07.
You're right in the center of it then.
Oh yeah, '07, everything's ripping. The group was, hundreds of people. Little did we know a year later it would be like 5 people. I remember actually watching an internal video from Mesref, and Sonny was talking about his
This
role.
is Mesref, is Morgan Stanley Real Estate Fund. Sonny is Sonny Kalsi, for those who don't know.
And Sonny Kalsi said something that really just spoke to me about the asset class and about the tangibility, and that really resonated. I went back to Emory, completed my BBA and concentration in real estate and finance.
Oh, so this was as an intern. This was even before you. Okay,
right.
got it. And so what did he say that resonated?
Just talking about the tangibility of the asset class and the real life impact that real estate investing can have in people's lives and in changing communities. Emory was a phenomenal place to learn the beginnings of my craft. I had some great professors there who were highly involved in the Atlanta real estate community. And it was one of the first times I realized that I was really good at something and was winning awards and was being recognized for a particular talent in real estate analytics. And, it was funny when I exited school, the world was falling apart. The CMBS desk was no longer, and I went to go take a generalist role at Jefferies in their investment banking desk.
So this was now in the '07, '08 timeframe, or probably '08. You just, the crash had sort of happened.
That's right.
And you were no longer originating large loans in the CMBS format, right? I mean, it went from like a $200 billion market to like almost nothing the next year. And so tell me about what you do.
Investment banking was a phenomenal learning ground, particularly during that time. There was distress everywhere. And I think of my experience at Jefferies as a kind of a master's degree in finance and in learning how to work it. I think their ethos really resonated with me. They operate with a lot of that entrepreneurial spirit. And they, at the time in particular, had a real chip on their shoulder with regards to entering into the bulge bracket and really establishing a name for themselves. I would tell you, When I got to Jefferies in 2008, there was absolutely no transaction volume, but it was a great firm to be at because the restructuring practice was extraordinarily well regarded there, and they
Right.
were really busy. So
Yeah.
I got a
You
lot of
learn a lot
reps.
doing workouts.
Yeah, exactly. I got a lot of reps working with the restructuring team. And, I was still very plugged into real estate and following what was happening in the world around me. And when I saw an opportunity to take what I had learned in CMBS origination, securitization, how the sausage was made, and exit and go work for a firm that was picking up the pieces of the GFC, finding arbitrage, finding dislocation, finding value. I took that. And after a little under 2 years at Jefferies, I moved over to Triangle Capital, was the first hire there, and helped grow that business into what it soon became.
To tell us about Triangle. I mean, I think Triangle Capital Group was effectively like a family office, but just explain
Sure.
a little bit
Yeah,
about what that was.
Triangle was founded by a family office, and basically came up around 2008, 2009 to effectuate a strategy buying distressed CMBS, CLOs, credit coming out of the GFC. At that time, what was unique is there was a real operational arbitrage in CMBS. Most CMBS professionals didn't have a tremendous grasp of underwriting the underlying real estate. They were certainly not real estate professionals. Meanwhile, most real estate folks, they just thought they were getting a loan from somebody. They didn't understand what happened to it, where it was contributed, how it was tranched out, how control played out. CMBS was really created as this asset class, diversified by product type, diversified by geography. It was never really supposed to have that much credit or distress. It was supposed to just be performing. It was an allocator product that was an alternative or a spread to treasuries.
Yeah,
But
it worked in an Excel model as opposed to
exactly,
working as an operating business or an
exactly.
operating model.
So,
Right.
when we started the firm, we were really just, I always had imposter syndrome. If I was in a room of real estate professionals, I was the CMBS guy. If I was in a room of CMBS professionals, I was the real estate guy. But we were three guys in a broom closet on 57th Street with a Bloomberg. The day after the GFC ended, effectively, like, let's go buy these pieces and let's use real estate intelligence, the understanding of what these assets are really worth, and apply that to the underlying loans and apply that, to the underlying bonds and figure out if we can identify an arbitrage. And there certainly was one. I think there were just very few real estate professionals that were sitting behind a Bloomberg and understood how to trade CMBS product. And there was also just very little liquidity in the system. So very few buyers. So as a small group with a relatively small amount of capital, we were taken seriously and our bid was credible. And we were able to execute that trade for a number of years, riding a lot of bonds back up close to par. The next trade that we realized was less about riding bonds back in appreciation, but more in control and controlling workouts. Where could you aggregate control in the CMBS stack to effectuate a tail wagging the dog phenomenon? And we were able to do that at a massive scale at Triangle, becoming what's called the controlling class representative or the directing certificate holder
You're
on.
taking me back to the days of tranche warfare where you have to figure
Exactly.
out
And I
where
was
the
right there
appraisal is
as a
likely to land and how to
totally.
take
No,
control of all sides. Sorry, keep going.
no, please. Yeah, I was a young guy early in my career. I was entrepreneurial and aggressive, and I was in a tremendous seat. We controlled tens of billions of dollars of mortgages that were hitting their maturity wall and needed to be worked out. And that experience, because of the nature of CMBS, again, being diversified by asset class and geography, gave me a tremendous breadth or purview of assets everywhere. And that just widened the aperture of what I was looking at in real estate. And, pretty shortly thereafter, what I understood across the variety of asset classes. And that's really stayed with me.
It's so interesting. It does feel like there are parallels to today, not in the sense that the publicly traded debt is having the same problems, but in the sense that It still feels like there's a disconnect in many ways between the real estate operating professionals versus the finance folks who sit behind either a Bloomberg terminal or an Excel screen all day. And there must be a way to bridge that. I think that's clearly an available market. And it also feels like there's just less capital available, right? Institutional real estate allocations have fallen or are moving to data centers. And so for the traditional real estate asset classes, it does feel like there are fewer bids. And therefore, do you see the same opportunity now or similar opportunity now to what you saw then?
Yeah, listen, I think we've seen just so much capital consolidation. And in that capital consolidation, we've seen a lot of sameness, a lot of firms that are all looking to do the same thing and not a lot of creativity and willingness to stray from the pack and do something different and figure out those arbitrage opportunities. And I think that's core to our culture and is something we continue to do, finding value where others aren't looking. And right now, most people seem to all be looking the same direction.
Yeah. It's so interesting. Well, so you had to change your perspective a little bit from either a CMBS originator or an investment banker to now being on the principal side, no longer working out problems that may have accidentally gotten stuck on your balance sheet, but to instead actually finding problems, other people's problems, and create opportunities. Now, you decided at some point to no longer do that at Triangle. You decided at some point, I want to start my own firm. So can you take us back to that moment? What was it about starting your own firm did you want to do? What was the internal drive and or the market opportunity?
You know, Working at Triangle was a phenomenal experience. I was always an entrepreneur and a business builder, and I wanted to lead my own platform. And I wanted to raise outside capital at scale. So I started SomeraRoad shortly after I got my MBA at Wharton, and I started with a deal. I was still very
What was this first deal?
I was still very connected to the CMBS space and understood the who, what, where, when, why of how those securitizations worked, where control sat, how special servicers and controlling bondholders behaved, and how you could wrangle control of an asset. And I would comb through CMBS tapes to understand where appraisals were and where underlying value was across any of these distressed mortgages. The first asset that caught my eye was actually an office building in Kansas City, which I had a way to acquire through a fair market value purchase option, a note on an office building in the River Market that we now call the 3Y building.
And you must have been very familiar with Kansas City at the time. I'm sure you spent lots and lots of time
I
in Kansas
actually had
City.
never been there before, but I knew about the market and I saw a lot of promise there. So I went and I spent 60 days on the ground learning everything about Kansas City. And my inkling was right. My hunch was right. There was a lot of value in that asset. I believe it had about a $20 million mortgage on it. It had been capitalized at a $30 million basis by 32 individual tenant and common owners called a TIC. It was in a lawsuit with the city. It had a lot of hair on it, but hair that I thought was relatively easy to solve. So fast forward, we bought the non-performing loan for $10 million. We completed the
So one
foreclosure.
third of the original capitalization.
Much shorter. The building was on the way to being entirely vacant, but it was a beautiful, relatively new, architecturally significant, LEED certified building in a great submarket in KC and a really good bite size, about 100,000 feet. We exercised the purchase of the note. Brian Harris at Ladder, he and I had a nice relationship. I had just started a firm. I was just a kid with a dream, and he gave me a chance and wrote me a loan. I raised money for the first time ever. I put my money where my mouth was and invested, a little over 10% of the capital to serve as the GP. We completed the foreclosure. We resolved the litigation with the city. We executed a value add business plan, improving the lobby, adding amenities, and fast forward, the building was 100% occupied. We returned all invested capital, and we built some phenomenal relationships in Kansas City with investors, tenants, brokers, and the overall market.
And now in some ways, I've obviously heard that story before and it continues to impress me, but it also feels like that story led to so many other things. How would you describe the investment philosophy of SomeraRoad?
Yeah, I think by and large, we're looking for arbitrage, dislocation, and an asymmetric risk profile where our downside is limited and we have an opportunity for an outsized upside return. But across all that, we're looking for an edge. We want to be doing something different. We want to be doing something unique. We always look ourselves in the mirror and ask ourselves, why us? What's our advantage here? Why is this a good opportunity for our team? And I think we've found that across the landscape.
Now, part of what you said you have to do this is I'm going back to your declaration. You said that you want to be aggressive and disciplined.
Mm-hmm.
What does that mean?
I think aggressive means a couple things. First off, I don't think there's a team in show business that works as hard as the folks here at SomeraRoad. But two, we are extraordinarily persistent. I always tell my team persistence against the resistance. If one door isn't opening, find another door. We work really hard to effectuate our goals. I think that's aggressiveness. I think discipline is, being sharp on the risks, being sharp on the underwriting, challenging yourself to really know thy markets, know the craft, and be precise in your assumptions.
What does it mean when you say know thy markets?
In Kansas City, we built a large investor base there, tenant relationships, broker relationships. We're now in the midst of a $550 million neighborhood renaissance redevelopment called the Historic West Bottoms. Built a phenomenal relationship with Mayor Quinn Lucas and his administration. And that's all just a function of that first deal. We enter these markets, we are honest, responsible, responsive counterparts. We do what we say we're going to do. We're earnest and we work hard. And that kind of just always leads to other opportunities. Our journey as a firm has all just been really opportunistic. One thing leads to another and things just evolve from there.
Hi, this is Todd Rich. Thank you for listening to the Declarations podcast, where top investors and business leaders share their insights and provide an independent perspective. We hope you're enjoying this episode. If you'd like to learn more about Declaration Partners or listen to more episodes of the Declarations podcast, please visit our website at www.declarationpartners.com. And now back to the episode. So, Ian, you talked about your background as a debt investor, obviously also opportunistic. And we even joked a little bit about the difference between operating folks and, operating real estate professionals and sort of the lending or Wall Street folks. But there's another notion out there that has always surprised me about you and your team, which is that debt folks are generally viewed as downside focused, whereas developers are generally viewed as, trees can grow to the sky optimists.
Yeah.
And you've somehow been able to create a business that combines this downside focused disciplined debt approach with an in-house development capability.
Yeah.
So how do you square that circle?
Totally. I mean, listen, again, everything that we've created as a firm in this 10-year journey has been opportunistic and a function of circumstance. When I think back to the core of what we do and what we're an opportunistic, distressed value add shop. When I look at the subsequent platforms, they've all been created by a specific opportunity. Take development as an example. About 6 years ago, we're sitting there. We've got all of these opportunistic deals or distressed deals under our belt, and a handful of them came with land sites that we were adding value to by proving real estate that's adjacent to them. And with that land, we could do a couple.
And you could only do that presumably after you already owned the real estate, right? You weren't doing this as a debt holder. So you've now foreclosed,
You're right.
Taken over, and now
Absolutely.
You own the land.
Absolutely. These were value add deals that we had improved that had adjacent land. We could sell that land, not a tremendous amount of value there. We could JV with a development partner, or we could roll up our sleeves and figure it out. And that's really our culture. So the first thing Fergus and I did and said, hey, let's go bring on a head of development. We found Andrew Donchez, who's now my partner and
your partner, right?
Head of our development business, head of our Nashville office. And Andrew spoke our language. And initially he came in to take these 3 land sites in Cleveland, Pittsburgh, and Nashville and build new multifamily vertical developments there. Fast forward, not only has he delivered those 3, but he's delivered or are in production on $1.4 billion of new construction vertical development. He has a team of 15 people. He's built luxury condos, retail, multi, opportunity zone deals, non-opportunity zone deals. We have stuff in Kansas City, in Indianapolis, in Nashville, in Pittsburgh, in Cleveland. And we're so proud of what we've created as a development firm.
Well, let's focus just for a second on Nashville, because I happen to, met with your team a few times in Nashville. I've toured your project. I'm still hoping to get a table. Can't get a table at this Michelin-starred restaurant that you guys put there called Catbird Seat. But how is it that you established a second headquarters there, right?
Yeah.
You're the headquarters in New York, obviously, and in Nashville. How did that happen, and how is it working now?
Everything at SomeraRoad is always kind of a story, but I'll tell you the quick version there. It was 2016, and I got a call from a friend of mine who was a lender to Gibson Guitars. And he said, hey, Gibson is about to go bankrupt. They really need liquidity. They own some non-core real estate on their balance sheet in this area of Nashville called the Gulch. Would you guys be interested in buying it?
And for those who are not real estate folks, the Gulch became an amazing real estate development. It's just lots and lots of buildings. It's a huge mixed use environment with great residential. Obviously, it retains some of the music culture to which you're referring.
It became the epicenter of growth in one of the fastest growing cities in the country. And I said to my buddy Adam, I would love to look at that. I'll be on a plane tomorrow. And I was down in Nashville working with Gibson the next day. And over the next year, we acquired a half dozen properties from Gibson off market, helping them inject some liquidity into their business. We learned in Nashville, we were early there. The market was just taking off. There weren't a lot of other institutional players there. And we really established a great foothold as that market was ripping. We became market experts there. We started doing a handful of deals. And during the pandemic, we decided we need to have a larger presence there. Nashville is growing as a market. It's a high quality of life, a low cost of living, great climate, great culture, fun city, 0% state income tax. It's a great place to hire, keep people longer, fulfill the American dream. And not only do we need people there to run our assets, but maybe we should really develop a team there and develop a core there. Fast forward, we have about 15, 20 people that work out of our Nashville office. We have an HQ there. We've been nominated the last few years for Developer of the Year. I think we have a ceremony next week for NIAB's Developer of the Year. We're nominated again, so fingers crossed.
Well, good luck. Good luck.
Thank you. And two of my partners, Andrew Donchez and Jonathan Reeser, run that office and do a phenomenal job. But it's integral to our company, and it's equal to our New York City presence.
So New York City presence, where again I've met you there several times. You're now also developing or redeveloping, I guess, in New York City, specifically in Brooklyn. I know you live in Brooklyn. It's been reported in the press that you guys actually just closed on the Bossard Hotel in Brooklyn Heights, and you have a sort of a development or adaptive reuse angle there. So can you just, in some ways, it actually feels like it culminates many of the different things that you've done in Somera, right? You've bought some debt, you're redeveloping or developing. Maybe talk us through what you're intending to do.
Yeah, so I've lived in and around Brooklyn Heights for the last decade. And as I've, walked my kids to school or walked around the neighborhood, I've stared up at this incredible building on Hicks and Montague called the Bossard Hotel, this historic, beautiful icon of an asset that's been vacant for the last 13 years. And as a real estate professional, as a distressed professional, I looked at that and figured out what's going on here and why can't there be something more? And after literally 3 years of pursuit, we were able to find a way to get control over the asset. We love doing historic building, adaptive reuse and rehabilitation, giving them new life. So there we are executing a by right repositioning of the asset from a vacant hotel to luxury for sale condos. And we couldn't be more excited about the project.
So are you going to put another restaurant there that I can't get a reservation at? Is that the plan?
I will tell you, there is an incredible restaurant going there that I'm excited to announce in the next 2 months. And I will absolutely make sure that you can get a reservation there whenever you want, Todd.
Great. You heard it here first. So approaching 10 years in. So perhaps it's different from the beginning, but you now have four core verticals.
Sure.
You still do the opportunistic investing that I think was sort of true to your, origin story, but now you're actually in new construction and development. You have a net leased industrial, sort of vertical, and your newest or most recent one is the SR aviation infrastructure. So I just want to say that as you've done this, I feel like you have in fact evolved into these more organized thoughts. I mean, do you feel like that's true, or do you still retain some of the entrepreneurial grit? How do you do both?
We've developed these unique skill sets and we've entered new verticals. But when you take a step back, we are really intentionally unintentional. Like we are just opportunistic. We go where we see opportunity. Like aviation, for example, was just a deal. A dear friend, investor, and partner sent to me and said, "Hey, there's this asset in Las Vegas owned by an octogenarian gentleman who doesn't really have a next in kin or a plan for the asset. I think it's one of the crown jewels in aviation infrastructure. I know you know a thing or two about private aviation, and I know you're a dog that likes to hunt. This will be a tough transaction to get over the finish line, but I think you should get to know this guy and see if there's anything to do." And I spent 3 years getting to know the seller. He was not a seller when I first met him. And after a couple years, we were able to pry the deal loose. So we rolled up our sleeves and learned absolutely everything we could about this asset, Quail Air Center in Las Vegas, now known as SRAI Las Vegas, at what was formerly McCarran Airport, now Harry Reid Las Vegas International. And what we saw was tremendous supply and demand fundamentals, no new supply, exponentially growing demand, a market in Las Vegas that was seeing a tremendous in-migration of ultra high net worth individuals, tremendous growth across private aviation during and post COVID, a deterioration of commercial aviation, planes getting bigger, new supply non-existent in the hangar space. And we felt there was a phenomenal mark-to-market opportunity on the triple net rents and the underlying hangars, as well as the fuel premium surcharge that we charge in Las Vegas.
So when you describe aviation real estate, which is obviously what the strategy is, Las Vegas being where you started you bought the property and you created this SR aviation business. Aviation real estate to you, it's hangars that are associated with FBOs and it's a fuel business on the side, or is there more to it?
I would say it's largely private jet hangars to FBOs, aviation related businesses, private jet owners, corporate jet owners. It's largely a real estate business.
So if our listeners are having a parking problem for their jets, you're
right.
the guy to call?
That's
is that
right.
it?
Yeah, that's right. I say you don't park your Ferrari in your driveway at home. You don't park your Global on the ramp at Teterboro. You want to put it in a hangar. It's in most places, your most expensive possession, you want to protect it, particularly as that protection, that hangar is a very small percentage of your total cost of goods sold or your total flight operation. We learned not only was there a great mark-to-market opportunity in Las Vegas, but this was a really fascinating category. That supply and demand fundamental was omnipresent across the country, and the industry was highly fragmented. And we saw the same fundamentals that people had seen in marinas, in RV parks, in storage, in cold storage, in data centers. We saw an opportunity to be category creators, to build the first institutional sized portfolio of aviation infrastructure assets. And that's what we set out to do. So we augmented our team with some great folks. We built out that core competency. And today we own a little over $400 million of private aviation real estate assets. We have a dedicated team of just under a dozen people that specifically focus on aviation related real estate. And we're really excited about the growth of that business.
And just because I've heard the story and my dad's an accountant, so I can't help myself. One of the attractive aspects about aviation real estate is that there's accelerated depreciation. And so can you just talk a little bit about, who your investor base generally is and what are some of the things that they find appealing?
I mean, we never saw this coming and it was definitely not part of our underwriting. But as we dug in, we learned that there was accelerated depreciation or bonus depreciation on a large chunk of the asset. In the tax code, there's something called land improvements, And when you think of a hangar asset, more than 50% of the overall piece of real estate is what we call the ramp, or what people think of like as the concrete extension of the runway, the areas that are not covered by buildings. Those buildings fall under 32-year standard depreciation that can be improved with cost segregation, but the ramp is 100% depreciable year one because land improvements are 100% depreciable year one. That obviously was stepping down on a scale over the course of the last few years. But then with the passing of the One Big Beautiful Bill Act by Donald Trump's administration, all of those accelerated depreciation qualified components went back up to 100%. That's been a real windfall for this business that we didn't expect. The other nuance about the business is all of these assets sit on long-term ground leases with the local jurisdiction. When you're on a ground lease, 100% of the asset qualifies for depreciation because there's no land component. It's a really interesting vehicle from a depreciation perspective.
The business that Declaration and SomeraRoad, where we're partners, is meant to take advantage of some of these new depreciation changes that were in the One Big Beautiful Bill Act, where, there are certain other asset classes outside of aviation that also qualify now for 100% accelerated depreciation. And what we're trying to do is to acquire specifically credit net leased gas station assets. So do you want to walk through a little bit about how do you see that opportunity?
Yeah, with bonus depreciation, a portion of the investment can be fully depreciated upfront in year one rather than over time. We usually think of a 32-year schedule with commercial real estate, a 27.5-year schedule with residential. The catch is with bonus depreciation is that for most real estate, only a small percentage is actually eligible for bonus. However, there are certain niche asset types, car washes, cell towers, billboards, gas station being our focus, where up to 90% of the purchase price, everything but that land allocation, can be fully bonus depreciated in year one.
So for those who don't understand how bonus depreciation works, or depreciation maybe even generally, to step back at a kindergarten level of tax planning, I'm not giving tax advice here, but depreciation creates a non-cash loss.
That's right.
That in a partnership structure would get passed through to the ultimate beneficial owner. That beneficial owner, to the extent they have other qualifying income, generally passive or private K-1 income, they would be able to utilize that loss to offset their income, therefore reducing their current year tax liability.
Or future years if you carry it forward.
Oh, right. You're saying if you don't have enough income today, you still get the loss, you just carry it forward.
I believe
right?
depreciation is a phenomenal benefit of investing in real estate. Assets, these physical assets fall under various schedules. There's a whole industry around what's called cost segregation in real estate, which segregates components of your real estate and puts it on its own useful life or depreciation schedules. And the tax code over recent years has encouraged capital investment in things like real estate by creating bonus depreciation elements.
It reminds me of Sam Zell, who I will paraphrase in part because I don't want to use the four-letter words that he would have used, but I've heard him say it a few times live, was if you really care about liquidity in real estate, invest in a public REIT. But if you're willing to live with illiquidity, well, then I'll say, darn it, take the depreciation. And I think that's to your point. It's quite attractive, particularly for long-term holders. And so why, with all these different asset types that now qualify, why credit leased gas stations?
There's a few reasons. First off, it's an asset that gets the 100% bonus depreciation net of the land allocation. Second, they have long-term 15 to 20-year absolute net leases. You have tenants like 7-Eleven, Wawa, Circle K, all with these corporate guarantees. The bite size is small enough, but also large enough to attract a large funnel of buyers and demand.
They're typically located on hard corners. That could make it challenging to develop new supply.
They're regulated, so that creates a new supply barrier. We think it's just a great asset class to realize this benefit.
I sort of think of it almost simplistically to benefit from this depreciation pass-through loss. And ultimately, you have to pay it back in the form of sort of depreciation recapture in the tax code, assuming that you still are alive to do so. And so if you're able to utilize that tax code to acquire inflationary real estate, something with growth, well, then you just compound.
Totally. Let's
So
explain that to your listeners. I mean, the federal high-end tax rate is 37%. Add the 3.8, you're around 41%. So, if you have $1 million of gains, you owe $410,000. You were talking about the negative interest rate loan from the government. The way you effectuate that is if you take the depreciation and you pay no taxes, in the end, eventually, when you do sell said asset, you do have to pay taxes on what we call depreciation recapture. But the depreciation recapture rate is 25 plus the 3.8, so 29%. So you're arbitraging paying 41% going down to 29%, which is, and you're borrowing that money from the government.
just to stick with your example, so if I had $1 million of passive income, my tax rate of the 41% would be just over $400,000. But you're saying at the end, when I ultimately sell the asset, which might be next year, it might be 15 years from now, 20 years from now, whenever it is, if I were to ultimately sell that asset, I would have not repaid the 400,000. I would have instead repaid approximately 280,000.
That's right. So it's a negative interest rate loan from the federal government. And I don't want to be too morbid here, but if you pass during the hold period, it's effectively entirely forgivable. We're not like going for the moon, but the power of compounding is incredible.
Now, the gas station, just to play that out, I guess in theory, one doesn't need to own the gas station itself for that entire period of time, right? The way the tax code works is that in theory, one could sell the gas stations as what they call a 1031 exchange,
right?
Buy a different asset. Is that part of?
That's exactly right. In our investment strategy, that's the intent. We think gas stations are the perfect widget to realize the bonus depreciation in the initial year, but we don't want to be over concentrated in gas stations long term.
So theoretically, taking a pool of gas stations,
creating the tax benefit, and then 1031ing those dollars into a diversified pool of long-term hold real estate. Think credit leased industrial, multifamily, triple net leased retail, high quality long-term hold assets.
It isn't for everyone, but it's fascinating to me how there's all this talk in the press about this goal from the really large institutional investment managers to focus on what they call the wealth clients, the retail wealth clients. And they, I guess, have created all these strategies to do so. And yet so few of them think in the way that I would imagine wealthy families or individuals think about, which is to think about net after tax returns. It's a fascinating phenomenon. I imagine that will change over time, but that's for a different day.
And it's also for real estate professionals. If you file as a real estate professional, you can take real estate depreciation against your active income.
Yeah. I won't say that that's why I got into the real estate business, Ian, but I will say that, again, I'll restate, my dad was an accountant. And so they joke that I was born with a green visor. I love this stuff. But just so that we don't bore our audience with tax stuff, let's go back to your company.
Happy to.
I mentioned earlier, you're approaching your 10-year anniversary, which,
right.
By the way, kudos. As a fellow entrepreneur, started my own company about 8 years ago. I know how hard the road is and what an amazing achievement it is to get there. So first off, congrats.
Thank you.
But when you look out to the next 10 years or 20 years, right? What do you see that looking like? And maybe how would you want SomeraRoad's work to be described?
I get this question a lot. Like, what's the 5-year plan? What's the 10-year plan? Where do you want the firm to grow? We've gone through this journey so opportunistically, so entrepreneurially. We never had this grandiose plan to be where we are today. If I put it simply and I think about what I want to continue working hard and challenging myself and learning new things. I want to continue surrounding myself with incredibly talented people that share that ethos. I want to keep learning, and I want to be investing in real estate and finding new ways to make money in real estate. That's the core principle. And the ways that we structure that, the verticals that we enter, the strategies that we undertake, time will tell. We love looking for opportunity where others are not, and I'm sure we will find new creative ways to put ourselves to work over the next 10 years.
Well, I'm sure as you maintain that entrepreneurial grit, you're aggressive and disciplined, and you always be kind, which was also in your declaration. I'm sure you'll achieve that.
My wife wrote that part, but it is true. And I do honor that.
Well, let's circle to your wife. When you and I first met, we're both at that stage in our lives where the family is important and becomes more important. So now, right, you actually have 3 kids under the age of 5.
Yep.
So tell me about, and obviously you're married, you just mentioned that. So tell me about your home life. What do you like to do when you're not working?
Yeah. No, I have 3 beautiful kids, a 4-year-old, a 2-year-old, and a 1-year-old, and an amazing wife, my wife, Virginia. We live in Brooklyn, and my weekends are filled with juggling the 3 of them. They are everything to me, and love spending time together as a family.
Ian, this has been a great conversation, but it is time in our conversation where we have to go to the standard closing questions. What was a book that most influenced your thinking or your personal development?
I'm going to give you 3, if that's okay.
3 books. That's a new record, I think.
Zen and the Art of Motorcycle Maintenance was a great book that I read in
Great
high
book.
school that really introduced my thinking. When I was at Wharton, I read a book that changed my leadership style for the better. What Got You Here Won't Get You There, which I highly recommend. And lastly, I love Danny Meyer's book, Setting the Table. Phenomenal book on hospitality that has definitely influenced my way of thinking.
So I have been giving that book out. I actually think you may be the 3rd or the 4th podcast guest who mentioned that book. It's incredible how influential he must have been.
If you like that, you should also read Will Godar's Unreasonable Hospitality. Great
Fantastic.
book.
And obviously also, we should watch The Bear to see that some of the
100%.
lessons from both books are actually being lived out. Let's go to the questions again. So what is the best advice that you've received from your parents or now give to your own kids?
I think it's really about grit and believing in yourself. My wife is Latina. Our kids are bilingual. And for my daughter, we affectionately call her Lucia la Luchadora.
La luchadora. I love that. The fighter.
And so she's a fighter. And I think, all my kids are fighters. And I think that's a really important attribute for them to have.
That's great. Okay. Now the last one. So the Declaration of Independence talks about the rights or the freedom for life, liberty, and the pursuit of happiness. What do you do in pursuit of happiness?
I think the things that make me happy are the people around me, whether it's professionally. I think SomeraRoad is filled with some incredible people that I really enjoy spending time with. At home, my 3 little munchkins keep me busy and keep me happy and keep me fulfilled. And so does my beautiful wife. I think, time is finite in life, and it's the people you spend it with that make you happy. And I couldn't be happier about the folks that surround me today.
I couldn't agree more. And I can't thank you enough for choosing to spend some of that time with me and with our listeners here on the Declarations podcast. Ian, this has been fantastic. Thank you.
I enjoyed the time with you, and it certainly gave me some happiness. Thank you, Todd.
This podcast is provided for discussion and informational purposes only, for use by Declaration Partners LP, together with its affiliates, referred to as Declaration. The information discussed in this podcast may change at any time without notice, and there is no duty by Declaration to update any person to whom this information is provided. This podcast does not constitute an offer to sell or the solicitation of an offer to purchase any investment product or any interest in the fund or any other investment vehicles or accounts managed or advised by Declaration, a Declaration investment product, in any jurisdiction to any person. Any such offer or solicitation for interest in any Declaration investment product will only be made pursuant to such Declaration investment product's definitive offering documents, which contain a description of the material terms, including risk factors, conflicts of interest, fees and charges, and regulatory and tax considerations relating to such Declaration investment product, and which should be reviewed carefully by potential investors prior to making an investment decision. This podcast does not constitute tax or legal advice. The listener is urged to consult a professional tax and/or legal advisors regarding the possible tax, legal, economic, regulatory, or other risks and consequences associated with any investment, and must be able to bear the risks involved. This podcast may contain certain forward-looking statements, which constitute Declaration's views with respect to future events, which can be identified by the use of forward-looking terminology, such as intend, seek, expect, target, project, or endeavor. These statements are made based upon such views as they exist as of the date herein. There is no assurance that such views are correct or will prove, with the passage of time, to be correct. Actual events or results may differ materially from those contemplated by such forward-looking statements as a result of factors beyond Declaration's control, including, without limitation, any disruptions in global, regional, or local financial, credit, or real estate markets, acts of God, fire, hurricanes, tropical storms, floods, earthquakes, or other natural disasters, outbreaks of an infectious disease, pandemic, or any other serious public health concern, war, terrorism, labor strikes, electricity shortages, or other national or local emergencies, or any combination of the foregoing. David M. Rubenstein is an anchor investor in Declaration Partners Real Estate Fund II and is not an employee of Declaration. Neither the U.S. Securities and Exchange Commission nor the Securities Regulatory Authority of any state or other jurisdiction has passed upon the accuracy or adequacy of this podcast. No compensation has been awarded to any speaker for statements made that are either testimonials or endorsements. However, certain speakers may be current or former investors in certain Declaration investment products and may receive reduced fees, priority terms, priority access, co-investment rates, among other preferential treatment, which may pose a conflict of interest. Certain speakers may also be affiliates and/or service providers that receive compensation from Declaration for services provided in their service provider capacity, but have not been compensated specifically for any testimonials or endorsements made herein. The views expressed in this podcast by either the guest speaker or the host are their own and may not reflect the views of their firm or its affiliates or of Declaration. The comments made are for informational and educational purposes only and should not be considered investment, legal, or tax advice, nor a recommendation or offer to buy or sell any security or investment product. Any references to advisory services, private investments, or wealth management practices are general in nature and not indicative of future results. Past performance is not indicative of future outcomes. Examples and observations shared by the guest speaker are illustrative only and may not reflect actual client experiences. Listeners should consult their own professional advisors regarding their individual circumstances. The guest speaker may have professional relationships that could present potential conflicts of interest related to statements made by the speaker. Consequently, from the foregoing, no reliance whatsoever should be placed on this podcast, and no decision, including any investment decision, should be made based on this podcast or on the information contained herein.